Archie, 31 years in this career, and never have I had so many questions from clients about CDs.
Well, Rob, that's really piqued my interest. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to Last Paycheck. We're your hosts, certified financial planners Archie Hoxton and Rob Hoxton. And today, we're going to talk about interest rates. What's going on with interest rates? Over the last 10 to 15 years, there have been some major changes, particularly in the last 2 years. So we're gonna talk about that and how that may impact you and how you should think about it, and maybe some things you can do to improve your situation. So Rob, what's been going on with interest rates? Get us up to speed on what's been going on.
Well, savers are finally being rewarded for saving. There's no doubt about that. Interest rates have really moved much higher. I think, last week I bought lots of CDs for clients, and we were getting them, over 5%.
Yeah.
Now, it was more difficult to get them over 5% once you got out past about 3 years. But in the shorter term CDs, that's pretty much where they were. And that's after rates that were, sub 1% for years. In fact, probably half of my career rates were low like that. So it's definitely looking up for retirees who want to earn interest on CDs. Or don't like investing. They're able to get something that may be slightly higher than core inflation right now. So that's good news for them.
Yeah, absolutely. Some of you out there may remember a time when CDs and bonds were paying double-digit interest rates.
In some cases, like 13%.
Yeah. And this would have been following the crazy inflation that took place, 40, 50 years ago. And so, it's starting to look not quite like that, but it's looking up. And so for those of you who took advantage of that, or maybe your parents took advantage of that, this is looking good. But just to kind of rewind and look back, for the last 10 or 15 years, really starting with the financial crisis of 2008, 2009, when the economy really went into free fall. And so you saw the Federal Reserve slashing interest rates to try to stimulate the economy. And they went to basically rock bottom and basically stayed there for quite some time. So in that time period, we saw incredible economic growth, great investment returns for stocks, not as much for bonds, definitely not for CDs and money market and that kind of thing. But we saw a lot of economic growth, right? Businesses were able to borrow really cheaply to grow and expand, building new facilities. They didn't have to spend, 4, 5, 6, 7% in interest to do that. So, and so many of us benefited in one way or another from that period of low interest rates. But what do we do now that interest rates have come back up? And now, that there are impacts to economic growth that come along with that.
Well, there's been so much speculation about what's going to happen next because of the Fed's increasing of interest rates. The number of increases last year was really alarming, frankly, and that's not all they were doing, of course. So there was there was a tremendous amount of tightening and reducing of the money supply. The raising of interest rates was but one of the strategies, and the idea, of course, was to slow the economy and to bring inflation to heel. And those strategies have worked pretty well. Inflation is much lower than it was a year ago. We're starting to see, energy prices rise again, gas rise again. Some of that is seasonal, the end of summer and people are traveling like crazy. So they're spending more money on gas that pushes prices higher. But it's true and it's more than just going back to the Great Recession. Interest rates were falling before that. And they really picked up steam as we ended up in that very difficult economic situation. And you're right, Archie, that the government really, and the world's governments really intervened to increase liquidity, increase money supply, lower interest rates. In some cases, interest rates on Treasury securities, not only ours but other countries, were actually negative. I mean, you were actually having to pay the government to hold your money, which just seems insane, but it's true. And as that was happening, as those rates were coming down, bond performance was really quite good. Bonds went up in value. Remember that sort of teeter-totter effect. Rates go down, bond prices go up. We saw the opposite of that last year as interest rates went up very quickly. Bond prices came down and created the worst bond bear market in over 100 years. But yeah, so there's definitely a lot of change, and it's at once both a positive and a negative, and it just depends maybe on what phase of your life you're in,
Right.
And what your financial situation looks like.
Yeah. So for me, I'm accumulating. I'm trying to, build a life for my family, and so we just bought a house, and I'd been thinking about doing that for a long time and looking at interest rates and working on my credit. And I was thinking, oh, this is going to be great. I'm going to be able to get, a great mortgage with a great interest rate. And then 2022 unfolded and interest rates went through the roof, and it just wasn't the case.
I'm going to say it. Cry me a river. My first mortgage rate was 12.5%.
Okay. Well, you've got me beat almost double there. So
anyway, all joking aside, yeah. I mean, that was a really quick move. I mean, people were getting 2 3/4, 3% mortgages.
Right.
Just that alone drove housing prices much higher. So you found yourself sort of at this sort of pincher where housing prices had gone up in part because of pent-up demand and in part because of really cheap money in the way of low mortgage rates. So you had houses that were really highly priced, and you had interest rates on mortgages that were going up, and it was being exacerbated by the fact that anybody who already had a mortgage didn't want to sell their house because they didn't want to give up that 3% mortgage. So now suddenly there's a supply shortage.
Right.
So yeah, it was kind of like the perfect storm. Fortunately, you were able to get a really nice little house.
We got very lucky.
Yeah. So, but it is tough. It is a difficult situation for particularly young people who are doing it, or even retirees who want to downsize. So a big part of the financial plan strategy for lots of people is once they get to retirement age, maybe they move to a state that has no income tax. Mm-hmm. There are a couple of those, Florida, Tennessee, a couple of others. And they downsize. So they sell their big house, they buy a small house, have a lower payment. Yep. Well, right now you could sell your big house, buy a less expensive, smaller house, and because the interest rate on the mortgage is higher, your payment's the same.
Yeah.
What a bummer.
Right. Yeah, and that really can, because that's something that a lot of people count on. They just take that for granted. So, there are opportunities that are closed off because of that. And this is a very unique market, right? I mean, it's like you said, existing homeowners are not necessarily willing to give up their interest rates. So they decide, well, we'll just hold off. So a huge amount, larger than normal, of the housing supply are new builds, which that comes with its own set of challenges and potentially putting off, if that was a piece of your retirement plan, maybe putting that off and waiting until something is built.
So there, one of the hardest things to do in finance is to predict the direction of interest rates.
Yeah.
Or to predict what the Fed will do. And there are so many experts out there that'll tell you what's going to happen next. But, after 31 years of doing this, I think this is probably one of the most difficult sort of guesses or prognostications to make, and that is where are interest rates going. And it's evident in the way that we've helped our clients with investments. We had really short-term bonds for a long time. We had kept expecting interest rates to rise. I mean, they couldn't go any lower,
Right.
but we were in front of that maybe too early. I don't know, because you just can't predict it. So where are interest rates going to go next? There's a lot of speculation that if the Fed slows the economy, then and maybe it dips us into recession, that the Fed will then be able to cut interest rates, because at that point maybe inflation isn't a factor.
Right. And maybe the bigger priority is actually re-stimulating the economy so that we don't, head into a deep recession.
What if we get stagflation, which is a period of inflation with no economic growth?
Yeah.
So, I mean, there are lots of different scenarios, that being one of them. Just this weekend, Goldman Sachs, who it does a pretty good job of predicting what's going to happen with the economy, said that the likelihood of a recession in the next 12 months is, basically, I don't want to say zero. I said like 20%. And for them, that's basically zero, because they're never going to say that the chance is zero.
It's always, 15 to 20%, because it's part of the cycle.
Anything under 25% for these big organizations usually is kind of a green flag that we aren't going to have a recession in the short term. So who knows? But just 6 months ago, a lot of these big organizations on Wall Street were calling for recessions. So
a lot of them were basically, I think I heard the term coin flip a few times. I mean, it was a kind of a 50-50. But that's all come down, which is good.
Well, since you said a flip of the coin, there was a great article in the Wall Street Journal this weekend about rising interest rates and what that can mean for retirees. And it also covered, what does it mean for banks? What does it mean for businesses trying to raise capital, as you were talking about? The flip side of the coin for retirees is, they get a higher interest rate on their savings, but what are the negatives?
Well, so, I mean, if you're earning, a higher interest rate, you've got to contend with the fact that it's going to be really tempting to put your eggs there, and maybe too many of your eggs there. When you have to keep in mind, inflation, it generally outpaces these short-term savings instruments, CDs, treasuries, money markets, high yield savings accounts. So there can be a temptation to just dump everything there, because you're earning more than you would have been able to for the past 15 years, maybe ever in your life, depending on how much you've shopped around for that kind of thing for, savings. But over the long haul, inflation has always outperformed cash. And so there's a temptation to overdo it with cash, even when it's really attractive.
Well, if your primary objective right now is to get the highest interest rate on a CD, or to get the highest, yield to maturity on a treasury, then you would be buying them all about 12 months out.
Yeah.
Right? Because we have an inverted yield curve, one in which short-term rates are really more favorable, certainly on a risk-adjusted basis, than long-term rates. So you would be buying all of these 12-month CDs. The problem with that is that they all come due at the same time.
Yeah.
What if interest rates have gone lower at that point, and you haven't laddered those maturities so that you have staggered maturities with different interest rates, so that you never want to be in a position where you have to reinvest your entire portfolio. You want to be reinvesting part of it and going out longer, because in time that yield curve should normalize, right?
Yeah.
And the longer dated CDs or bonds will be paying a higher rate, right?
Yeah. Yeah. Yeah, and that's a great point, because that's one thing that a lot of people don't think about. If you're you don't want to be too short-sighted and say, oh, well, I've got, a great deal right here in front of me, and not think about, well, it's the term is reinvestment risk. How will you be able to reinvest? At what rate will you be able to reinvest that? We don't really know. So laddering instruments is a great way to do that. And then keeping a short-term cash in maybe something that fluctuates more, like a savings account or a money market, something that you might need to pull, maybe an emergency fund, a smaller piece, because that is going to change over time as interest rates change. High yield savings went up tremendously over the course of 1 year as interest rates rose. They will go down just as quickly when interest rates are cut.
Another great thing to think about is if you are retired and you have adult children who maybe they're trying to buy their first house, or they need to borrow money, and they're running into these higher rates, you could maybe expect to get a call from them. That is, hey, Mom, Dad, maybe you could lend us the money and we'll pay you interest. And maybe the interest rate could be a little more favorable than we can get, traditionally through a car loan, a mortgage. So think about that now. Get your answer square between the two of you so that you can have a unified front in telling them no. So,
Yeah.
Right.
Yeah.
So that's an unintended consequence of rising interest rates, particularly for retirees.
Yeah. Yeah. So, and these are all things to think about. There are a lot of ways that you can maximize your money, have it working for you in a low risk way that's paying more than it has in a long time. But just keep those things in mind. Remember, long term, what are you going to be able to reinvest your pot of money at if it's all in the same maturity? So, think about that. Manage that little known risk that many people don't talk about. And then again, it's don't try to read. Don't try to read what the market's going to do. Don't try to anticipate. So I'd say that's just about everything we were going to cover today. So I hope you enjoyed it, and remember to subscribe and share with your friends and family, and we'll see you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.